That was July 5th, 1998. In August 1998, Russia defaulted on its loans. In September 1998, long-term capital management fails. Now let's talk about long-term capital management for a minute. Long-term capital management was a premier hedge fund run by Fisher Black and Robert Merton. They set it up because they were Nobel Prize winners for their formula. You had to have a minimum of $10 million for them to consider you as one of their participants, and it had made 40% a year for the previous 2 years. 40% one year, and then another 40% the second year. However, in September 1998, it failed because it didn't recognize the possibility that an entire major arbitrage unit would fail and that a government would default on its loans at the same time. That happened in 1998. The feds came in. They managed to find enough assets to basically break it even. The notational value of the contracts under long-term capital management exceeded $1 trillion. A derivative is a bet. They were betting over $1 trillion. They had no margin left. And now something very interesting happens. Note that this is all before the mortgage crisis of 2004, 5, 6, 7. And Fannie Mae and Freddie Mac. That hadn't happened yet. And yet we were given warning after thief, after incompetent, after bad computer program. All these warnings took effect. And then, in late 1999, the Graham-Leach-Bliley Act was passed, dismantling the walls separating commercial banks, investment banks, and insurance companies. Since the Great Depression, a commercial bank, which serves commerce and businesses, an investment bank, which serves people trying to get a new business or a new factory built, who are investing in something new, building a new business, and insurance companies must be of separate businesses. They can't be combined under one roof and under one corporate structure because this was part of the 1929 and 1931 crashes. Stock market crashed in October of 1929, recovered half of it in 1930, and then crashed again in 1931, and it went down from Black Monday in May of 1931, the day the Empire State Building opened, into 1932, until it lost 89% of its pre-29 value. In order to prevent that from happening again, investment banks, commercial banks, and stock brokerages were separated from each other, and the banks were further separated by state and subject to state banking rules to prevent this sort of quagmire and over-leveraging situation from ever coming up again. However, in late 1999, the Graham-Leach-Bliley Act disbanded these protections. December 15th, 2000, this was a day or 2 days after the Supreme Court decided that George W. Bush was our president. And the news, and then the front page news was all buzzing with how important the political change was going to be and the fact that this was going to be our new president. And under the cover of this, the Commodity Futures Modernization Act was passed. It was authored by Phil Gramm and signed into law by then President William Clinton. The Commodity Futures Modernization Act is a very peculiar piece of legislation. It says that except for the futures based on commodities that are traded in Chicago, all other futures can be traded as they wish with no reserve requirements, no insurance requirements. You can't sue them. They're not subject to state gambling laws. They're basically completely unregulated by federal fiat. That's what that act said. Now, what happened from 2000 to 2008 was that these qualitative, non-market derivatives that were traded by computers, that were basically cooked up by lawyers, and sometimes some of these are 300 or 400 pages long in the contracts. They're contracts between corporations that bet on a certain outcome. And there was no regulation or restriction on them at the federal or state level. They exploded and went up and up and up in value every single year. The main news for the next couple of years was the mortgage market, which was expanding and exploding, and then there were some danger signs, and then it started falling apart. But let's go back to derivatives. let's go back to the non-mortgage derivatives. In 2004, the Securities and Exchange Commission proposed a voluntary system of market regulation. The big investment banks opted to join, but the holding companies would be permitted to follow their own computer models to assess how much risk they were taking. The SEC would get access to make sure the complex capital and risk management models were up to the job. So they weren't auditing and regulating the organization and its interests. They were checking the models. And that was their supervision, and that was their regulation. I have no argument about the list of mistakes with the credit default swaps and with the mortgages that we discussed from Brookings Institution. And most of those events took place between 2004 and 2007. I concur with that analysis, but it's only about 35% of the picture. What I'm discussing with my timeline is the other 65%. All right? Things continued without any regulation and without much interest, although the SEC decided that its voluntary inspection model would continue in 2006. March 17, 2008, Bear Stearns, a large investment bank, was acquired by JP Morgan Chase with a guarantee from the Federal Reserve Board because JP Morgan Chase didn't want to touch it. Its offer was $0, and it had to be bribed to acquire Bear Stearns, a large investment bank, with Fed cash. September 7th, 2008, Fannie Mae and Freddie Mac are placed in conservatorship by Federal Housing Finance Agency. And I want to note that the Fannie Mae and Freddie Mac were investigated by the Justice Department, and that ultimately action was taken against its executive who was using derivatives to show regular, slowly, steadily increasing profits, which is illegal. But that particular individual later became a financial advisor to the economic plans of presidential candidate Barack Obama. Phil Graham, who authored the Commodities Act of 2000, basically making it unregulated, later became the principal financial advisor to presidential candidate John McCain. This indicates that the investment community and the banking community has its claws and its lobbyists very deeply into both political parties. September 14th, 2008, only 7 days later, Bank of America announced its intention to acquire Merrill Lynch. The transaction was finalized on December 5th, 2008, and there is a lot of current controversy about this and about the actions of the Fed and about the desire of the president of Bank of America not to get into this particular high-risk acquisition. That's still a current story. September 15th, 2008, Lehman Brothers files for bankruptcy, and the Lehman Brothers files for bankruptcy, and the Treasury Department decides to let it go, to show that it's independent and that it's not going to take care of everybody. September 16th, the very next day, AIG broke from a derivatives-based liquidity crisis. The federal loans to the AIG soon approached $85 billion. I believe they were given 40 and then another 45 in a very rapid succession.